Value Investing, 2011, 2012. Ron Hosen. This is part 3. I think I ran over in part 2. So, in part 3, let me go over the ways that one can invest to take advantage on the ineptitude of the American economy. As long as the U.S. economy is not producing 3-4% economic growth, as long as new jobs are not being created, as long as there's some political concern, as long as the Fed continues to try to use monetary policy to stimulate the U.S. economy, we're going to have very, very low short-term rates. If you purchased a CD recently, you know that. Now, the Fed is trying to pump up the stock market by purchasing U.S. government securities, by purchasing U.S. government bonds being issued by the U.S. Treasury to pay its bills. And as long as it's purchasing those, it frees up money that otherwise people would use to buy Treasury bonds, and perhaps they'll buy equities. Why the hell the Fed cares whether people buy equities is a more interesting question. But at least on CNBC, they seem to think that this is called the wealth effect, as opposed to, say, the poverty effect. And that is, people will become excited when they see their 401k balances have gone up 3%. I think it would be more interesting if the whole thing hadn't been telegraphed. I mean, over time, when people feel richer, they do spend a little more, at least in the United States. Germany's different. So, but here we've got the Fed deliberately attempting to pump up share prices, not increasing real goods and services, and that people will be fooled by this, they're thinking they're rich, and then they'll rush out and spend, and that will provide an opportunity for real goods and services to be produced and sold. Okay. As long as the Fed is committed to very, very low short-term rates, people in the financial sector, the investment banks, can borrow at virtually nothing and lend out to intermediaries and to speculators. So, I want to give you the symbols for a couple of speculative mortgage REITs. What the Fed has done is bought up mortgage-backed securities held by Fannie and Freddie. That is, they bid up the prices and they guaranteed them. Since the federal government took over Fannie and Freddie, the federal government guarantees the bonds issued backed by mortgages. A mortgage REIT buys up a bond issued and guaranteed by the federal government and maybe earns 4.5% on it. and then they borrow at 2.5% from Goldman Sachs, JP Morgan, and they earn the difference. Then they take the mortgage-backed securities that they purchased and they use it as collateral and they borrow more. So in the end, they can borrow about $6 for every dollar of capital. Now, most of these companies went broke in '08, but there were a few that started in '08. That is, they raised fresh capital, and they've used that as basically as a basis for borrowing more and buying these mortgage-backed securities. So, one is called agency mortgage, something like that, AGNC, and it pays about 18–19%. Another one is Annaly Mortgage. It pays about 15%, NLY. Hatteras Financial, HTS, and then there's one that buys distressed debt, and its symbol is IVR. Now these companies are paying out every quarter a dividend that, if they kept it up, would be 15, 16, 17, 18%. These are enormous returns. And they've kept it up. They've been doing this for 2 years. Now, if short-term rates were to go up, if the Fed raised interest rates or began to sell off some of the bonds that they've been buying and cause short-term rates to rise, well, these companies would get burned. They would be paying, let's say, 5% for the money they borrowed and only earning 3.5 or 4 on the stuff they purchased. So they get killed. But that's not going to happen, because in my opinion, the U.S. economy is dead in the water. Each month we create 4 million new jobs and we lose 4 million jobs. And so maybe it'll go up to 4.2. But I don't see any reason for the U.S. to have economic growth. Now, let me give you a little background, and then you can decide for yourself. If short-term rates stay low for another year, then these little REITs are bonanzas. The only thing you have to worry about is that after they pay these dividends, the stock price goes down in the very short term by the amount of the dividend. It's like they've earned this interest for the last 3 months, and when they pay it out to their shareholders, then they're that much poorer. The shareholder is richer, but they're that much poorer, so the stock goes down. But if you hold it until, say, a week before they actually pay the dividend, there's a good chance the shares would have gone up, and probably by as much as the dividend. And so you can sell it and get a capital gain. So that's what I've been doing. I've been selling, holding it for a month or two, and when I've got a 2 or 3% return, 2 or 3% in 2 months, that's like 18% a year, then I'd sell it. So, that's a thought. Why is it that the United States can't sustain economic growth? Well, I think what you have to do is look at the nature of our economy. I think a very substantial portion of the American population, and this is the higher paid people, are engaged in what are essentially parasitic kinds of employment. lawyers, accountants, people in financial services, college professors, particularly economists, both economists who are consultants or in private industry, or economists in the academic world. Politicians who alternate between personal enrichment and self-aggrandizement, mostly self-aggrandizement. But if you want to feel like you're really important, get elected to office. And if you're rich to begin with, you got a leg up because you can pay for your own campaign. Educational administrators, basically, all of these people are marketers of either material or spiritual dreck. Like the what's the name of the minister at Greenway Plaza?
Joel Osteen?
Joel Osteen, yes. I mean, this is a purveyor of spiritual dreck and a recipient of quite a bit of money. So, anybody who's engaged in financial services, let's say you're a mutual fund manager, or you've got money in a hedge fund, or you have a retirement. Well, these people just move money around. I mean, one makes money and another loses money. So, I basically support my niece by investing her money, getting a 20% return. 20%! A 20% return, and she lives on it. So does that make me a parasite? You betcha. I mean, I haven't earned anything for her, and she sure hadn't earned anything for herself. We got it from somebody, somebody who was making a mistake that I capitalized on. So, and I'm unemployed. I have no marketable skills. So I can afford to sit around and watch Bloomberg and CNBC all day and turn in a 20% annualized record. If I were not an amateur, then I would be out trying to market my services, trying to induce people to invest in my funds. And like you, these people would be losing their asses. But the nature of the parasitism, I mean, it doesn't really say anything about the personal morality of the people. I mean, if you get a job teaching at a college, you have to kiss the ass of the senior professor. And so, you write a dissertation on what he wants you to write. And if it's somebody like Friedman, then it's going to be bullshit. Or like anybody who's ever been in any department. And I was in college for 26 years. And my 26 years of experience in college indicates that these people don't know shit. But if you want to make a living, then essentially you do things that please them. And that means you don't come up with any ideas. Fortunately, I never wanted to make a living. Okay, we'll go to part 4. If anybody's interested, stick around.